Now we can move into looking at accrual entries, and these are a little more complicated because cash doesn't move or has not moved yet. So I'm breaking this into a 2x2 matrix, and the first covers items that are revenue items and when did we get the cash. In the first case, we had revenue items before the cash moved. In other words, we gave product to our customers, so we earned the revenue before they paid us. That's pretty typical. And that's called a receivable. So an accounts receivable represents amount that our customers owe us for goods or services that we gave to our customer. So we earn the money, but they owe us money. The other side here in yellow is where we did it in reverse. The customer pay us money, but we haven't done anything yet, right? So we can't count revenue for something we didn't do. So in that case, cash goes up and a liability account called unearned revenue goes up, which means we kind of owe them either the products that they wanted or we got to give them back their money, right? So that's why it's a liability and not revenue. The second group here is the expense item, and this is when did the expense happen. First is where the expense happened before we paid for it, and that's typical. The janitor comes and cleans the building. So we have to accrue the expense because we owe it to him, and we have to have a liability, create a liability called an accrued expense because we owe the janitor money. The other case is where it's the opposite, where we paid money out, but we haven't yet used the goods or services for that yet. And an example of this would be insurance. So we pay a year's insurance in advance, and at the moment we made the payment, we've had no expense yet. We haven't used any insurance. But every month when we use the insurance, we charge for a month of insurance. So it starts off as an asset, and then it starts peeling away every month, 1 month at a time, as we use it and expense it. So we're going to look at some examples here. So on a prepaid expense, here we pay $200 in advance for advertising time. Cash goes out down by $200, that's right here, and an asset account goes up. Now, even though advertisement will eventually be expense, when we first prepaid, we haven't used any yet, so it's an asset until we use it. The next line here is we used it, so we can subtract $50 worth of time that we used, and we expense it as a negative $50 to our income statement. Next is unearned revenue. What did we get? We got $400. That's a plus to cash. We didn't do any work yet, so it's a liability called unearned revenue, plus 400. And then when we do the work, we can reduce the 400 here, and now we can count it as a sale. And now we would reduce the inventory that we shipped to supply the customer with the product as promised, and that's cost of goods sold. So this part here looks a lot like recording a transaction. That's a normal sale, but this is the tricky part, where we got money before we actually ship the goods. Accrued expense, this is where we had wages in this example. We owe wages of $100, so our liabilities go up because we owe somebody money. Our expenses go up by 100 because it's an expense. And when we get around to paying our employees, I hope it's not too long, cash goes down 100 and our liability goes down by 100. So next we have accrued revenues, and this is a very typical example. We shipped $500 worth of iPods to a customer. That creates a receivable from that customer for $500, and we can record the sale of $500 as part of our income statement. Now, we had to do something to earn that money. We sold them some of our products, so we have to reduce our inventory by the cost of the items we sold, in this case $400, and we would increase the expenses on our income statement, in this case cost of goods sold, by $400 to offset the money we got. So if you just look at this section right here, we had revenues of 500, we had cost of 400, so we netted, or we had gross profit on that sale of $100. Other adjustments we'll do a little later in the course. I just want to give you a preview for them. Depreciation, that's like the table where you spend money to buy some hard asset for a long time, and as you use it, you allocate the cost to that particular period. Bad debt, this reflects that sometimes people say they're going to pay us and they don't. So this is how we do accounting for bad debt. Again, we'll cover this later. Next, a write-off. A write-off basically means that you have an asset that is held on the books at a certain dollar amount. It's not worth that, so we have to reduce the value, and that is when we write off an asset. Next is marketable securities. In the case of marketable securities, it's marketable, so we actually have very accurate data on the value of those securities at any point in time. It's what it's traded at on the stock exchange or the bond markets. So there's a whole way of treating these using what we call mark to market. We'll see that in the investment section. And finally, investments in other companies. This is very common because big companies now often get bigger by buying another company. And those are called intercorporate investments. And that's what we're going to look at in that chapter. And these are simply previews to show we didn't learn it all in 2 days. Put our hand to doing these accrual entries. All right, so the first transaction is accrued expense of $67.28. It's right here. When we accrue it, that means we didn't spend it, which means we owe money. So we're going to have $67.28 as accrued expense. And here on the income statement, we'll just call it an operating expense since it was vague about it. So the amount is negative $67.28. And depreciation expense of $9,400. We already explained what that is. So it's an account that goes against or reduces the asset value. So you have the asset account called gross PP&E, and you subtract from it accumulated depreciation. So here, negative $9,400, and we have expenses of depreciation expense of minus $9,400. Okay, amortization. Amortization is when you have an asset that goes down in value, but is not a fixed asset like a table. So here we have in other assets, probably things like royalties or a use of patents. And here we've used up negative 1857. That's amortization. It's a fancy word that sounds like depreciation for other assets. Okay, so here we have amortization, negative 1857. And our last one is we earn some of our deferred revenue of $84.91. And so now we can take it into revenue of $84.91. Revenue goes up. So now we've done all our transactions and we can see how we're doing. All right, so now where are we? We've put in beginning balances. We've recorded all the transactions and we have a subtotal. So let's look at those subtotals. It's here, this row, very important row, trial balance, and I'll just put it in a different color. Let's go orange. The sum of the assets, which is this command here, is 290. So assets equals liabilities plus equity, all this, and it equals, so this means we're in balance. Okay, so now we know we're in balance. Posted the beginning balances, we posted all the transactions, we sum them all, get to this orange row, and the assets equals liabilities. So that accomplishes step 3 is trial balance. Are we in balance? Are assets equal liability and equity? Thank God the answer is yes. What do we do next? We generate financial statements.